Welcome. Today's January 6th, 2022. We enter the new year and it's a very interesting time. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. Daily Five is the show where we talk about the five most important charts to us. And we've entitled this episode as Getting in Front of the 7-Year Cycle. It'll be the last chart we talk about, but it'll be the most important chart. But to start, I'd like to just try and examine the market a little bit and do a little trend analysis. So let's look at our first chart for the day. It is a 2-year daily chart of the S&P 500. It's a close-only chart, so we're kind of avoiding the daily noise and really just seeing where the market ends up at the end of each day. So the chart looks through yesterday's close. And what we're really seeing is that the market closed right at support. Support is basically 4,700, give or take a couple of points. The market likes those round numbers. And it really didn't do any damage to the chart whatsoever. We've been in what I've described before as a textbook bull market advance. And what is a textbook bull market advance? Well, bull market advance is defined by a sustained uptrend, and that's exactly what we've had. Notwithstanding periodic 2, 3, 4% periods of volatility, which is normal. An uptrend is, by definition, a series of higher highs followed by higher lows. And the only way to get a higher low is to experience those 2 to 5% periods of volatility. Now, the uptrend generally is illustrated by a series of moving averages that capture the short-term, intermediate-term, and long-term price swings. And those are typically represented by the 10 or 20-day moving average on the short side, the 50 or 100-day moving average on the intermediate side, and typically the 200-day moving average is the general definition of the long-term trend. So what we've done is we've illustrated the 50-day moving average in green and the 200-day moving average in red. These are simple moving averages, so nothing fancy here. A few other characteristics that we can point out is that, a bull market advance generally includes a well-defined trend channel, and we certainly have that. We've highlighted that in gray, and it pretty clearly marks almost definitively the lows and many of the highs on this advance dating back to at least the middle of 2020. Another interesting feature or characteristic of bull market advances are these periodic range consolidations. They're typically bound by very clear support and resistance levels. And once those resistance levels are resolved to the upside, the trend can advance. However, if the support levels are violated, it then brings into question the validity of the trend, or whether or not the trend is continue to remain intact. And so, what we've done is we've identified key support, which was prior resistance at 4,700 rather. And then the next level of support is 4,500. And I think if we were to breach the 4,500 level, it would definitely bring into question whether the market is in a deeper sort of corrective state that could challenge the 4,300 lows of early October. And so, we're nowhere near that at this point. It's premature to really discuss it. But I think at this point, as long as we hold above 47 and maybe more importantly, the trend line and the 50-day moving average, then the textbook bull market advance will remain intact. And at this point, we can project a measured move to approximately 5,000 on the S&P based on the prior breakout above the 4,700 and an intraday level of, say, 4,744. So we're currently looking for the advance to carry to around 5,000 before we have to really think about the next serious correction. So with that, let's move on to chart number 2 and take a little bit deeper dive into the more granular swings of the market. Here we're looking at an Elliott Wave count over about that same period of time on the left-hand side of this presentation. And what we're seeing here is really kind of a steady weekly range advance. We've counted this to really where we're in intermediate wave 5. And so the real question is, where are we within intermediate wave 5? And we look at 5-wave impulsive advances. And so to really define the initial trajectory. And so to the right, we're looking at a blown up kind of magnified version of that final leg of the advance intermediate wave 5. And since October, which we marked as intermediate wave 4, we've seen one 5-leg advance to the upside, which we're marking as minor wave 1. And since that, we've seen a 3-wave correction that brought us back down to around, say 4,500-ish. And we've marked that as intermediate wave 2. Where we think we are right now is in a subdivision of minor wave 3. And so we're looking at minute wave 1 having carried up to the November highs, and the pullback through today's low looks like it's minute wave 2. And so we should be putting in those lows today or tomorrow, probably above the 4640 level, which would be a 61.8% retracement of the initial leg up, that minute wave 1. And so as long as we kind of hold in and around that 50-day moving average, I don't think there's really anything to really be too concerned about. The count would be invalidated if it were to breach 4529 for all practical purposes. So as long as we're above that level, the count's valid. And as long as we're above the 50-day moving average, the trend is valid. So that's where we stand today. Now, chart number 3 takes a look at what concerns us. We've got this kind of volatile period of time that we're experiencing right now. There's a lot of things out there that we could be concerned about. The narratives include, the Fed's tightening actions. People were talking about the minutes yesterday, and this acceleration of tapering and unwinding of the Fed's balance sheet. And when will the first Fed rate hike occur? Will it be mid-year? Will it be sooner? We're starting to get a lot of indications from various VIPs out there in Fedland that are intimating that we could see something that surprises versus current expectations on the downside. We've also seen 10-year bond yields, which we're not showing in our chart pack today, but we've seen 10-year bond yields rally pretty substantially since year end. We closed out about 151 on the 10-year yield at year end. We've since pushed up over 20 basis points to recent highs around, say, 172 or so. And so, that is resolving a very short-term base pattern of the inverted head and shoulders variety to the upside. So, that narrative has a lot of people on edge because higher interest rates suggest multiple compression. And so we're seeing this occur actually in the technicals. What this chart is describing to us is the advanced decline line, which is the advanced decline line is a cumulative measure of net advancing issues on the NYSE Composite Index, which is one of the broadest true measures of the equity market. In fact, it includes some 2,200 stocks, and they're of all market caps. The weighting is kind of a free float market cap weight. It actually also includes 360 ADRs, so non-US companies, many of which are Chinese. And so when we see in the lower panel, this NYSE Primary Exchange Composite Index making new all-time highs as recently as December 28th, okay, and then this week pulling back, yet we did not see the advanced decline line confirm it. In fact, the advanced decline line put in a substantially lower high, creating what's known to market technicians as a negative divergence. And what is a negative divergence? Negative divergence is basically when the number of advancing issues does not expand cumulatively with price. So it fails to confirm price. And it really means that the breadth of participation within the index is narrowing. And that narrowness of breadth creates some concerns. And so, one point is that, not all major market corrections are preceded by negative divergences. We've had several that were not, in fact, as recently as the great financial crisis in 2007-8. However, almost all, and I could even say all negative divergences do precede market corrections of some degree. Sometimes they're smaller degree corrections of just 5 or 10%. Sometimes they're major drawdowns of 20 to 40 and even 50%, as we've seen following the great tech bubble and things of that nature. So we need to be at least concerned about this. It can resolve. And if in fact we do see a resolution to the upside, in other words, a new high on the advanced decline line that confirms the next new high on the NYSE composite, then we really don't have to worry about it anymore at that juncture. But at this point, it remains unresolved and concerning since it's turned down below its 50-day moving average at this point. So we're keeping an eye on that. But let's take a look at chart number 4, see what other potholes might lie in the road ahead. Another one that has us on alert for a potential major correction is this long-term momentum divergence that we're illustrating here in the 30-year monthly close chart of the S&P, which is the top panel, and its 36-month momentum study on the lower panel. Now, one very illustrative way of measuring long-term, or what I would call structural momentum, is to calculate the deviations of price above and or below some long-term trend metric. I like to use the 36-month exponential moving average. I've long held that this is one of the truest measures of the long-term trend when we're looking at data series going back some 30 years or so here. Now, really what the momentum study does is it measures the ebb and flow of price relative to that moving average. It's kind of a way of detrending the market's price action and just looking at it purely as a function of its own rate of change, its intrinsic rate of change. And so, what a momentum divergence is when prices continue to advance to a new high, as they did as recently as Monday, and that rate of change decelerates. It fails to confirm, it fails to make its own new high. And what happens again is it forms what we market technicians like to refer to as a negative divergence. Now, negative divergences are very common precursors to a trend change. And when we're looking at a negative divergence on a 36-month momentum study of a 30-year monthly trend, that is a precursor to a potential major trend change. And so sometimes these divergences can persist for a while. There have been examples, we can even go back into the late 90s, where momentum diverged for years, upward 4 years. But typically, these momentum divergences occur and last for less than a year, and sometimes only for just a few months. And so far, we're looking at a multi-month negative divergence in long-term momentum, which has us on alert. Coupled with that negative divergence in breadth, the breadth of participation in the AD line, it holds more weight. Now, there is a third and final kind of concern that has really been on our mind in recent weeks and months. And chart number 5 illustrates that very well. So let's take a look at the next chart here. Chart number 5 is really looking at a little more magnified version of the lower panel of the preceding chart. What we've done is we've overlaid a 7-year cycle on that 30-year momentum study. Now, most cycle analysis focuses purely on price action to identify, peaks and troughs within, the cycle itself. But, I have found when you look at cycle analysis and overlay it on momentum, just view it through that lens of momentum, it can become even more clear and more pronounced. And so, I think what we're able to discern from this picture is that the cycles can be quite pronounced, and we're at a point where we're nearing the end of a 7-year cycle. And what does that mean? So 7 years is not an arbitrary period. That actually the history dates back some 6,000 years. And those who have any familiarity with, say, Old Testament theology expertise would understand that this derives from the Hebrew tradition as mandated by the Torah and described in the book of Exodus, Leviticus, and Deuteronomy. The 7-year cycle really refers to the Jewish agricultural cycle. And it's often referred to under the descriptive of Shmita or Shemita, which means to release or let go. And what Shmita is it actually refers to the 7th year of that 7-year cycle. And what the ancient Israelites considered back, 6,000 years ago was that, that 7th year should be taken as a sabbatical year. It's a year of renewal because Jewish law actually forbade landowners from working their land in the 7th year. It required them to forgive all of their outstanding debts except for those owed them from foreigners. And the purpose of that, it is thought, is that it allowed the Jewish economic cycle to reset. So those that experienced, a very strong 6 years, productive 6 years, economically successful 6 years, would have to take a rest. And those that did not would get an opportunity to kind of start over and maybe have, level the playing field, so to speak. And so, the whole notion of the 7-year cycle, dates back a long time. And actually, if you look back in just Dow Jones market history, going back 120 years or so, you can see that the 7th year has a long history of marking, in many cases, catastrophic events in the equity markets, but in most cases, periods of contraction in equity valuations, economic valuations, and oftentimes in commodity markets as well, sometimes even in rates markets. And so, what we've done in this chart is we've highlighted the beginning of the 7th year with that vertical blue line. And what we're hoping to do is illustrate how just before that 7th year begins, looking back over the past 30 years, we have consistently seen a negative momentum divergence signal that that 7th year is poised to roll over. And so that's exactly what we're seeing. We're seeing a lot of evidence of negative divergences in breadth and participation, momentum, heading into the 7th year of a 7-year cycle, the Shmita year, which is a very apparent history of adverse market events, dating back 120 years. And we've got a list of those that we can provide our viewers if they want to reach out to us and just send us an email or something. We would be happy to provide the entire list of events that has been chronicled over 120 years, just to satisfy your curiosity. So the question remains at this point is, will we see that traditional 7th year downtrend? It remains to be seen, but in my opinion and experience, chance favors the prepared mind. So, we wanted to give you this presentation so that you understood what you're up against here as it pertains to history. With that, I just flipped to the final slide, which will show you how to get in touch with me. You can send me an email at jhuge@jwhinvestment.com or visit my website, jwhinvestment.com. You can follow me on Twitter at alpha_insights and see, all of my regular posts, which we put out a lot of free content. In fact, we just published our annual newsletter forecast, and I think we have something like 180 likes or something on it at this point. So it's pretty popular. You can also find me on LinkedIn. With that, I would like to thank everybody for watching today and wish you well in your trading endeavors going forward.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.